Okay, so what you do for your trading project, let's write this as a brief here. So this is for yesterday. Okay, I added some links here. I think what I'll try to do is all the hyperlinks. I mean, I may add some extra hyperlinks here. Just check the top of the page. I added this other web page. This is a good website. You can learn from this. You won't get wrong information on this. Okay, so on this website. So this is quite a useful if you want to learn additional things about finance and also revise some of the material you've been taught. Okay, today is 27th. Is that right? 27/6. Okay, so what is the first thing that we are doing is the project brief. Okay, so this is an informal project brief. I'll give you more formal details later. Essentially what it's going to be, so NSE Nifty 50 stocks only. Okay, so obviously there are many stocks listed on the NSE. So you're going to be trading your universe of tradable markets is going to be the Nifty 50 stocks. Okay, and so what you'll have to do is you'll be buying and selling. So we will run a long short equity fund. Okay, it'll be you'll have live market data. You'll have live market data. So you'll have to run you'll have to run a long short equity fund. Okay, using the Nifty 50 stocks. So you can buy or sell any of the Nifty 50 stocks, okay, as much as your capital allows. I think they will initially give you paper capital of $1 billion in each account, okay. So with that amount of money, whatever is allowed to you and whatever amount you can trade, okay, you can trade those stocks. You can buy and sell any kind of stocks. The investment mandate will allow you to go long or go short, okay, those stocks. So what you should already start doing is start preparing from now, because we'll get the software operational only on 8th of July. We'll get the logins. So what you should already start practicing is start looking at the Nifty 50 stocks and start following them, and try to put yourself in a situation as to how are you going to, like, if you have to take a decision. Essentially what you'll have to do is you'll have to look at every stock, okay, if you go to a daily as an initial view, okay. So if you take any stock, let's say if you take ITC, okay, now you have to start looking at ITC and deciding whether you want to buy or sell, okay. And in this similar manner, you have to form your views on every other Nifty 50 stock. So obviously when I say the universe of tradable markets is the Nifty 50 stocks, okay, each of the stocks is going to be treated as a market, okay. So you'll learn the definition of markets later on, but I'm just giving you a brief overview at the moment, because you should start preparing yourself mentally. List out the Nifty 50 stocks, okay, and then look at each of the stocks in turn, okay, or you can start with a shorter list and then expand the list, and then start forming your views, because eventually you will have to take decisions either to buy or to sell, because if you don't do anything, then you don't make any return, okay. So eventually you're going to be evaluated based on your risk adjusted return, okay. So the risk adjusted, so that means you can't just take the maximum position, because if you have a drawdown, the risk adjusted return will be taken as your drawdown, your total return divided by the drawdown. The drawdown is essentially the amount of money you've lost. I'll explain all these terms, but broadly what it means is that you can't just madly take the biggest position possible, because on that position, if you have a large drawdown is essentially the loss that you suffer from the highest level in your account value, okay. So if you take a huge position thinking you'll make a lot of money, but then it starts going against you, you'll suffer a large drawdown, which means at the end your denominator will go up. So your ratio, which is the number on which you'll be evaluated. So the grading will be totally objective. Okay, so I wanted to eliminate any kind of subjectivity in the grading. The grading will be totally objective, so it will be your total return. Okay, so if let's say you make a 15% return, okay, but you suffered, let's say, a 12% drawdown. Okay, the maximum drawdown you suffered is 12%. In that case, your ratio is going to be 15 by 12. Okay, so therefore, so somebody who has a higher ratio than you will get higher marks. And the grading again is like everything else. It's like your CP grading that you've seen before, which means that the team which gets the highest score, so the percentage grading for this project is 30%, okay, is the 30% of the total weight. So the team that gets the highest score, okay, will get 100% on that 30%, okay, and then I will arbitrarily decide the percentage for the lowest ranked team. Okay, so it could be 30%, 40%, whatever I decide. Okay, so and everybody else will get prorated scores in between. Does that clear? Just like your CP scoring. Yeah?
Just like the relative market.
Just like?
Relative market.
Yeah, it's relative grading. So the team that comes first will get the 100%, full 100%, just like I scored your CP, the same way, okay? And then the only arbitrary input that is required here is what should be the percentage score for the lowest ranked team. That is something that I decide arbitrarily depending on how I feel the overall batch performance has been, whether they've put in enough effort, okay? So those kinds of consideration, and so then that's how your scoring will be, okay? So mainly what you have to be concerned with is that you obviously have to take risk, otherwise you can't make money. But at the same time, you can't just go in and take the whole amount of risk, because the amount of risk that you are taking is going to get reflected in your drawdown, and the drawdown is the denominator. The maximum drawdown is the denominator. So you have to also be mindful about how much risk you're taking. Okay, so therefore you should start familiarizing yourself with this list of Nifty 50 stocks. Okay, use the money control charts. The money control has what you can use is a combination of these two charts. Money control doesn't have very good intraday charts. Okay, because you're going to be trading over a fairly short horizon. I think if your early September is your exam, right? So I might have the reporting if you want to keep trading. Well, normally for the exam, for one week before the exam, you'll be busy preparing, right? And then if you want to trade, so either we may stop it like at the end of August itself. Okay, so in which case we are looking at, if you get July 8th, we take 2 weeks of practice and then we start. So you'll get about 4 to 5 weeks of actual trading. So initially, once we get the logins, I'll give you 2 weeks or something. Ideally 2 weeks I would like to give you for practice. Okay, and then so we'll get a few accounts per team, and then we'll have some of the one account you keep clean. That's going to be a project trading account, and the other 2 accounts or 3 accounts you can use it for practice. Okay, so that's the basic plan. So what you have to start doing already before we get to July 8th, you can already start, because you know this is what you have to be doing. So you should already start looking at Nifty 50 stocks and start forming your views. So as far as using charts is concerned, you can use the money control charts for the longer term data. They have very good long term charts for Indian stocks, okay? But they don't have very good intraday charts. So you can combine that with this particular web page, this application, and this will give you good intraday charts. So you can see here, this obviously I've showed you, all this stuff you can get good intraday charts as well. This is just a daily chart, but you can get this on 5 minutes. So you can see, if you want to see the detail of this part, this last drop, you would go to 5 minutes. It's actually, you probably need 15 minutes because you can't see the full detail. Yeah, you can see that last part we were looking at on the daily chart. Now you can see much more detail over here. The advantage of this obviously is that it allows you to set tighter stops. So now if I'm very bearish and I want to go short, one easy stop for me is just here. Okay, it's just here, which is a previous high, and so there, if I lose money, I don't lose that much, from 275 to 281. Okay, so this is another way of keeping your drawdown low, is by having tight stops. Okay, but obviously there is a trade-off involved here, because if you have tighter stops, then you might get stopped out more often. Okay, and if you have wider stops, you will get stopped out less often. That's always true. But then if you actually get stopped on a wider stop, you lose more money. Are you following what I'm saying? So there is a trade-off involved here, which you have to think about. It's a probability of, you've done mathematical expectation, remember? What? Meyak is aggressively shaking her head. But you must have done it in QT1 or QT2. PIXI, summation PIXI. So it's probability of loss times magnitude of loss, and you sum all the probabilities, right? And the probability and product, it's like a weighted average. Mathematical expectation is a weighted average. It's a probability weighted average outcome. Okay, it's just like a weighted average. So it's nothing new. So in a way, this is talking about 2 things. It's the probability of losing money versus the amount of money you lose. So this is a trade-off that you have when you're setting your stops. If you set a very tight stop, you have the chance of getting stopped out is much higher. The probability of getting stopped out is much higher. But if you have, if you get stopped, you'll lose less money. Are you following? I hope nobody is looking blank. Are you following what I'm saying here? Everybody? Adarsh? Are you following? If I set a very tight stop, if I go short here at 275, so I just wanted to bring in the concept of mathematical expectation to refresh your memory, because I'm pretty sure it's been covered in one of the QTs, and maybe in QT2, right, where you do probability. So So I just, because in there, in mathematical expectation also you have these two ideas: probability of outcome versus magnitude of the outcome, right? You combine those two and then you sum them up, and then you get the probability of you get the expected value, or the it's called mathematical expectation in statistics, but in finance we call it expectation or expected value. Are you remembering all these terms? Yes, not everybody is nodding. Puneet is not able to recall all these terms. So I'm going to put them in your notes because we are discussing this term, okay, as part of the project brief, okay. You should revise this. This is already part of your material that has been covered. Mathematical expectation is the term that we use in statistics. Just look it up, okay. Mathematical expectation is stats, also called, okay, simply called expectation. In finance, we just call it expectation sometimes. Okay, also called expected value. Okay, these are all the same thing. These are all probability weighted average outcome. Okay, please revise it from your QT2 notes. Make sure your concepts are clear on these things. Very basic concept in finance. And if you to help avoid confusion, think of it as just a weighted average. Okay, because if you have, let's take out one of your sheets here from in your lecture notes. I've also added, we do a quick refresher on, I've also added a calc sheet so that if we have any calculations, we'll do them here. Okay, so there are some other, there's some stuff here which we have not yet covered, but I'll add a sheet here. We can just add a sheet for today. We can just call it, we'll just call it calc as a general figure. Okay, and we're doing it for, let's rehash this concept because we'll need it in many other places in finance. Okay, so if you have the probabilities here and you have the outcomes here, okay, so if we say that there is, like, let's say a 30% chance of let's say 100 centimeters of rain, okay, then there is a 25% chance of say 90 say let's say 80 centimeters of rain. So we come to 55, and let's make it simple and just cut it short. Then I have to add, obviously all the probabilities have to sum to 1, right? Okay, so then we have this, and let's say there's a 45% chance of 300 centimeters of rain. So here we'd say, what is the expected rainfall? Okay, what is the expected value of rainfall, or what is the mathematical expectation with respect to rainfall? Okay, so these are obviously future things, so we are trying to assess it through probabilities. So what we would do is, we would just do, first we would do pi xi. This is the xi, and this is the pi. Okay, then we would just copy this down here. Okay, and so this is the, so sum of the pi xi is the expected value of rainfall. Is everyone clear?
Yes, sir.
This is how you calculate mathematical expectation for any kind of future event which is uncertain. Okay, so if it's a certain event, then you just have, let's say there is a 100% chance of 300 millimeters of centimeters of rain. Then the expected value is, essentially you are using the same formula, but it's just 1 into 300 plus 0 into all the other possibilities. 0 into any other possibilities. So 100%, so that therefore you know that for certain you're getting 300 centimeters of rain. Okay, so are you following? So if there's any kind of future event where there are certain probabilities associated with certain types of outcomes, okay, so this is how you get the expected value. So this is a very basic concept in finance, and if you think about it, can you see that it's exactly like a weighted average? It's exactly like a weighted average. So it's actually not a new, so when mathematical expectation is taught, it should actually be taught as not anything new, But by the time you come to study mathematical expectation, you already know the concept of a weighted average. Okay, so all you're doing is you're just taking the average outcome, but instead of just adding it up, you're weighting the average outcomes with the probabilities. So that's why we say that mathematical expectation is a probability weighted average outcome. It's an average outcome. You could have just taken a simple average here. Instead of that, you're taking a weighted average by weighting it with the probabilities. Is everyone clear?
Yes, sir.
Okay. Until you're not clear.
Yeah, I'm clear.
Clear. Okay. So this is the concept. So you should be clear about this, and we can make use of this in your even in your present value calculations. Okay. When you do your present value calculations, we can discuss. Suppose you have, let's say, a bunch of cash flows. Okay, which you're trying to discount. Okay, suppose you have 185 in the first year. Okay, then you have whatever year 1, year 2, year 3. That's it. So the point I'm trying to make here is that usually what you are accustomed to doing in your present value calculations, what you're accustomed to doing in your present value calculation is that if you are projecting you're calculating the present value of some project, okay, of the returns from project, then what you would do, let's say you're expecting the first year cash flows to be 185. What you're typically doing is you're directly plugging in 185 out of somewhere, and remember, all of these are all projections, so no one really knows what's going to happen. Okay, it's just a shot in the dark. Okay, you have no basis really to be sure about it. It's just a projection. So it's very important to remember that everything in the future is, most of the things that we deal with in finance and economics in the future, everything is pretty much uncertain. Okay, so you should always have that, you should always remember that in your head. There is just a number. You might as well go down there and ask one of the rickshawalas, so give me a number, and you just plug it in, because it's just a number. Basically, you just pulled a number out of somewhere, because there's no guarantee that that number will actually transpire. Okay, so it's very important to remember that, because people, I think, get lost in all that. I've done so much work on my spreadsheet, so this has to be right, and they just get lost in it. So it's very important to remember that these are just projections, so they really have no real value. Okay, other than just some kind of a theoretical exercise. Okay, so the point I'm trying to, you're already familiar that if you're going to project the first year's cash flows as 185, you just typically just write 185, right? You just estimate that. So one of the things you can do as a refinement, one of the ways you can use expectation in your existing valuation exercises, is that typically, because we know it's an uncertain number, it's a future number, right? So we don't really know for sure that it's 185. Okay, so what you can do is, instead of writing this 185 like this, you should actually say, now we are changing it from rainfall to cash flows. Okay, let's just imagine these are cash flows. You should actually say, this is a better way of looking at it, that it's a more rigorous way of looking at it, that you say that in the first year we expect, we have a 30% chance of earning 100 million. Okay, we have a 25% chance of earning 80 million, and then we have a 45% chance of earning 300 million. Okay, and therefore the expected value of the first year cash flows is 185. Okay, and then you're discounting that. Okay, so that is a more rigorous way. This is another level of analysis that you can add to your normal projection, so that later on what happens is, for some reason, if you're adjusting the cash flows, okay, if your your project has already started, but you're looking at the ongoing viability of the project, you have to still project into the future. Okay, because there are many cases in the real world of business where people give up on projects. Like, I think it's, I can't remember the name of it. I think it's British Petroleum, or maybe Shell, one of the oil companies. I think it was Shell. They had invested $7 billion in an Alaskan oil pipeline, in an Alaskan oil project. Okay, so if you look at, if we increase this now to, let's say, 1 week, and we look at the volatility of oil prices. Okay, so oil, you know what WTI is? You know what WTI stands for? So WTI stands for West Texas Intermediate, which is a grade of US oil. Okay, so there are two major crude oils. So these things you have to understand. Okay, because oil is such a major commodity that everybody, even if you're not going to be a commodity analyst or an oil analyst, you need to understand the oil price. Okay, all these tensions that are going on in the Middle East right now with Iran and the US. Okay, you have to understand the politics and the economics of oil, because oil is such an important commodity. You can't afford not to be aware of it. Okay, even if you're going to be an equity analyst, you should have an understanding of, a pretty good understanding of the oil market. because these things like products like oil, copper, these are very important. Okay, so you should have a good understanding of these markets. Okay, gold as well also is a very speculative product. So if you look at this now what happened in that particular case was Shell had invested $7 billion in the Alaskan oil project. Okay, they were trying to explore for oil over there, but what happened was the assumption that they had made with respect to the oil price. Remember, if you're doing an oil exploration project, okay, so when you do the NPV analysis of the oil exploration project, what are the returns going to be based on? The oil price is going to be very important, because whatever you're producing, you're going to be producing oil, right? And the price at which you can sell that oil is a factor of what is the market price for oil. Because when the market price is $50, you can't say that I want $80 for my oil, right? So when you see, this is one of the reasons why you should understand that all future projections are all basically pie in the sky numbers. Okay, suppose I say 250 here and 375 here. These are all pie in the sky numbers. Okay, I'm just projecting, I'm making some assumptions about what will be the oil price. Okay, so typically when I'm making these sales estimates, sales revenue estimates, this is also coming out of the number of barrels I'm going to sell and the price per barrel. Okay, that's how you would do it. Number of units sold, number of iPhones sold times price per iPhone. That's how you'll get the sales revenue estimate, right? So now the problem is, although you can actually estimate probably the number of units sold, you can probably estimate a little better, but the price is a total up in the air number, because nobody knows what the price is. If you look at this chart, you can see how oil prices have moved. You can look at the years. So you had this long period when prices really did not move much at all. See, from 85 onwards, even until it broke out in 2004. So pretty much like a 20-year period when oil prices moved in a very tight range, from about $40 to about 10, 15, to about, I think this is the low, is around $15 or so, 10, $15. So 10 to 40, let's say. Are you able to see this? That suddenly things change. Can you see how dramatically things have changed? And this is a very, very important commodity. Okay, if you look at, so there are two major grades of oil. One is West Texas Intermediate, which is the North American grade. Okay, which is again very important because the US is the most important economy. And then there is Brent crude oil, which comes from the North Sea, okay, which is near the UK. So that's the grade of oil that we buy typically in India. We are closer to the Brent crude grade of oil, okay. Although we have now started buying some oil from the US also very recently. First few shipments have come out, okay. So very important to have an understanding of the oil market. So if you can see here, therefore there is a tremendous change in the volatility of the oil price, okay. Suddenly you see there's so much movement, and if you compare it to this previous 20-year period here and you compare this period here, it looks quite different. Okay, the volatility has changed. So what happened in the Shell oil refinery project and the Shell oil exploration project in Alaska was they had already invested $7 billion. Okay, but when they decided to start the project, okay, they had assumed that the oil price would be $100 a barrel. Okay, they had assumed a price realization based on an assumption of $100 a barrel for the price of oil. Okay, so as you can see here, $100 has not been seen since we had this big drop in 2014. So this cancellation of the project happened, I think, around 2016 or 17. Okay, when the price had already dropped here, and they didn't see much of a chance of recovering back to $100 a barrel oil. They would have started this because they might have planned the project somewhere around here. Okay, they might have decided to go in for the project when the price was somewhere around here, but suddenly the price has dropped here, and then you see that a particular project where they had planned to do this project with the average price realization of $100 a barrel. Okay, after investing $7 billion, they eventually realized that there is no chance of getting $100 a barrel for the remaining life of this project, which is what the reason we got into the discussion is that even after you start a project, okay, you still have an option to discontinue, okay, not to invest more money into the project because there's ongoing investments are required. So you will keep on doing analysis about the future, about the present value of the future return. So you keep on projecting future return. It's not that you just project once and you leave it. right? You have to keep on doing it on a dynamic basis. So the point is that the price of oil is an important the price of the commodity that you're selling, anything that you're selling when you're doing a particular project evaluation, the price is an important factor in the initial sales revenue estimates, right? And from the sales revenue estimates you get the eventual profit estimates, etc., that you plug in here. Okay, so the point is that you keep on doing these exercises on a dynamic basis, and you do have cases like what I discussed with you just now, that these Shell oil guys had started a exploration project in Alaska around this time, I guess, when the price was much higher. They had assumed $100 a barrel for oil prices, but when prices fell and they didn't see a chance of a recovery, they eventually, after investing $7 billion, they dropped the project. Okay, so that's basically saying it's a kind of a stop loss. Can you see that? That's also like a stop loss. The point that Shakshi was raising the other day, it's also like a stop loss. You say that, okay, I don't want to lose any more money on this project. I don't want to invest in this anymore. This is not going to pay off. So after 7 billion, they just gave it up. Okay. So this is what you have to understand. One is we brought in several ideas here. That one is the importance of the oil price. See how prices fluctuate and how your investment projections can all go haywire. Okay, you make certain projections, so it's very important to have a healthy level of skepticism about all the analysis that you're doing, so you don't get caught in the, I spent so much time building this huge spreadsheet, now I can't accept that this is not going to be true, right? So don't like fall in love with your analysis and your calculations, because this is not because life is very different. Okay, you can see how big companies like Shell, okay, which have all the resources that they have that anyone could have, and they invested so much money, and then eventually they had to scrap the project because they see that there's no chance of getting back. They feel, obviously they could be wrong, maybe something will happen and then the oil price will actually shoot back to $100. No one really knows. So maybe their decision even to pull out of the project or even to give up the project, that could also be wrong, because you could give it up and then suddenly the oil price might shoot up to $100 and stay higher, because after all it did go, in 2007 it went to about 147 and a half dollars. Okay, so if it could go there in 2007, how do you know for sure that it will never go there? Okay, so even the decision to give up the project is actually, that's also something that you don't know. I mean, you're not sure. That decision could end up looking stupid, because the day you decide to cancel the project, then after that next month the prices might start moving up. Okay, so the point to understand here is that in the whole investment business, okay, in anything to do with economics and finance and financial markets and economic variables, whenever you're looking at the future, it is just basically a pie in the sky projection. Okay, whenever you're making statements about the future, you have to understand that these things, these numbers and projections that you're making, they pretty much have no reliability. Okay, so obviously not no reliability, so let's say like very low levels of reliability. So you should not place too much of a bet on these things being right. Okay, are you following what I'm saying? Because we have covered a lot of things, so I don't want people to get confused. Okay, the reason I came into this discussion about the cancellation of a very big project is because I was trying to emphasize that when you do project evaluation, you don't just do it once and then decide to, because it's an ongoing, most projects require some ongoing investments, so you can always decide to pull out of the project. Okay, and the other thing to understand is that most of your projections that you're making for a project, if you're looking at a copper mine, if you're looking at investing in a copper mine, okay, the critical assumption there is going to be about the price of copper. Okay, because what's going to come out of a copper mine? Silver? What will come out of copper mine? Copper will come out, right? And you have to sell that copper on the international market. Copper is an internationally traded commodity, so the price of copper is being set in US dollars on the global markets. Even if you're selling copper in India, those guys, your customers in India, are going to refer to the global dollar price of copper, and they factor in the dollar rupee exchange rate, and then they will start looking at, okay, how much are you going to charge me? Because the international price is this much, right? So you can't overcharge me too much. Okay, you factor in the duties and all the import duties and stuff like that, but you can't charge too much above the international price. So essentially the international price of copper will determine the returns from a copper project. That's going to be the single biggest driver of the, so if you're doing a copper project evaluation and you're plugging in these numbers, the most critical assumption going into these numbers is your assumptions about the price of future price of copper. Are you following? Okay, so in everything, so you have to understand that all these number exercises that you've done in your NPV analysis, right? These are all based on you have to understand the most critical assumption here is about the price of the product which the project is going to generate. Okay, if it's a gold mine, then it's going to be the price of gold. If it's an oil exploration project, it's the price of oil, and so on and so forth. Okay, so this is an important thing to understand. And then the point I was saying is that the point I was trying to emphasize, also connecting it to expectation, is that if you do, instead of just directly saying that I'm going to get 185, if you do this 185, let it come as a derived number from this kind of exercise. Let it come as a derived number from this kind of exercise. So that's a more refined assessment of probabilities, so that later on when you're again doing further reruns of your evaluation, maybe something has happened and you want to change the probability, and you want to change this probability, instead of 45, maybe this will become 65, okay, and this will become just a 0.5%, maybe this will become just a, so we should have a check here. Alright, so you can change the probabilities or you can change the numbers. Okay, are you able to follow what I'm saying?
Yes, sir. Yes.
That is so far you have been used to directly just plugging in these numbers. Okay, because this exercise you'll be doing for, I mean, this is a very important part of most of the financial analysis that you do. Okay, and most models will basically have this kind of framework. So one of the things you can incorporate into all your analysis is, instead of directly plugging, there'll be a return number, and which you'll be discounting. You'll be discounting the return number. Everywhere it's the same concept. Okay. So instead of directly plugging in the return number, you can do a more refined analysis. Let the return number be just derived. Okay. Let it just be derived from the probabilistic assessment that you're doing at a more refined level. So instead of directly saying I'm going to get 229, you say I have a 30% chance of getting 100, and so on and so forth, and that's where the 229 comes from. Are you following? Okay, so this is an additional increment, that element that you can now add to your understanding of the present value of an asset. Okay, all right, is everyone clear so far? I hope I haven't confused anybody, because I have a tendency to jump from here to there, but this is also important because everything in life is actually interconnected. Nothing in life will come as one clear-cut problem. Everything is going to be interconnected, so you have to understand the you have to be comfortable with all the interconnections. Okay, is this clear? Okay, so we were discussing so the reason we got into mathematical expectation is because I was trying to show you that if you are trying to go short ITC, you can, one of the concerns that you will have is, no, this is not that ITC that we are looking at. So here look at the long-term chart of ITC. So one of the concerns you will have is, if you are feeling very bearish at this point, setting a stop on your short, on going short. Okay, the wider the stop, the reason we got into mathematical expectation is, the wider the stop, okay, the less the probability of the stop getting hit. Okay, because mathematical expectation uses two concepts: magnitude of outcome and probability of outcome. Are you following?
Yes, sir.
I hope nobody is losing me here. Now we are connecting back to the idea of stop and size of the stop versus probability of getting stopped out, and the amount of money you will lose. Okay, so in mathematical expectation we look at two things: outcome, the magnitude of the outcome, okay, and the probability of the outcome. Okay, all right. So here also, when you're setting stops, you have a choice whether you want to set a very wide stop. Okay, if you take this as if we take this as, let's say, 60 minutes. Okay, I think you'll see that point above 300. Okay, so here you have two choices. Let's say I'm very bearish and I want to go short. Okay, so I can just go, and to make things simple, I'll assume that I'm going short at market at 275. Okay, so I have two choices. I can either set a very wide stop at 310, 311. Okay, taking this high, okay, which you could also see on the daily charts. Okay, or I could be very conservative and I could set a stop here at 282. Okay, so now here you'll have to understand there is no perfect answer. Pretty much everywhere in finance you'll find that there is no perfect answer, whatever you do. Okay, just like that example of the Shell decision I gave you, where they spent $7 billion on an exploration project, and then they gave up, thinking that the oil price is never going to $100. But they could actually be they could be right or they could be wrong. Even the decision to give up could be right or wrong, because the next day the price might shoot up to $100 or it might drop to $35. Okay, so you never know what's going to happen. So there is no guarantee. Everything that you're doing is you're just taking a chance, and it may go your way or it may not go your way. Okay, so I could set the stop at 282 or I could set the stop at 311. Okay, so the point to understand the trade-off that you have, everything is just a matter of trade-off. The trade-off that you have is, if you set the stop at 311, the probability of getting triggered is much lower. Okay, is that clear to everyone? Because it's much further away from the market, so the probability of getting triggered is much lower. But if it gets triggered, then you lose a much bigger amount. So the magnitude of the outcome is very high. Is this clear? You will lose from 275 to 311. So the magnitude of the loss is very high, the probability of loss is lower. Okay, and whereas if I set it at 282, the probability of getting hit is much higher. But if I get stopped out at 282, the magnitude of my loss is much lower. Okay, so you should be clear about these concepts, that you should recognize these concepts. Okay, and then be able to also connect it to expectation, which you have learned, which is a very important concept. That you should, and it should also remind you that this is similar to the idea in mathematical expectation, where we take a probability weighted average outcome. So there again we are thinking about magnitude of outcome and probability of outcome. Is everyone clear?
Yes, sir.
Are you able to see the connection?
Yes.
Okay, all right. Okay, so that's basically, we are still on the initial project brief. What happened? Mayank has removed the clock. What happened? Huh? Okay, so we are still on the project brief. Now you have to get used to this. You have to look at ITC, form a view on ITC, and repeat it for every particular stock that you're looking at in the 50 stocks. Okay, form a view on ITC and decide: am I going to go long or am I going to go short? If I'm going to go short, as an example, then what is going to be my stop? And then this is part of your ongoing education. This is a very important part of your education, I would say. It's one of the most important things this most important types of skills you can develop. Okay, in any, not just for asset management, but even for corporate treasury risk management, because everywhere you'll have to take a view on markets. Okay, so practice doing this. I'm going to go short at 275, and let's say I do this trade. I decide to go short at 275 and I set a stop at 282. Okay, all right, and then maybe I have an idea that it's going to go much lower, below 250 or whatever. Okay, so then I have to watch what happens, because the next day something will happen. Either it will go down or it will go up. Now if you get stopped out, you should also start to think about what went wrong. Okay, because you have to be serious about it. You have to take this seriously. Don't just brush it off and then learn, because then you won't learn anything from it. Okay, so maybe what might happen is, this very often happens, maybe what will happen is it will break above 280 just after you go short. It will go above 282, where it will go to maybe 290 or 288, and then again it will drop. So you will feel like a fool, because you are right that eventually it did drop, but your stop was taken out. Okay, then you'll feel my stop was too tight. Okay, so then you'll feel I should have set my stop at 310, but then it might actually go and hit 310 also, 311. Okay, then in that case you've lost a pile of money, right? It's a much bigger amount that you've lost. Okay, whereas here I just lost 275 to 282. Okay, and here I'm losing 311 to 275. That's a big loss. So don't think that just because you got stopped out, now I'm going to set a wider stop, because then if the wider stops also get hit, then you lose a much bigger amount of money. So there's always a trade-off involved. So you have to try and figure out, what did I get wrong? Okay, how did I form my view? What did I get wrong? Keep evaluating this, keep evaluating your performance, and this is how you learn. So over time you'll get better. Eventually you might feel that nothing much is happening, I'm not able to follow what's going on. Okay, but this is the most important part. I would say this is one of the most important parts of your education, because you're dealing with real price movements. You're not looking at some capital asset pricing model or some theoretical stuff in your textbook. This is real stuff that is going on in the world. So if you can develop a feel for this, you can make money, and you don't really need much as I said, just a surfer does not need to have a PhD in fluid mechanics, right? A surfer can just go there and just practice, and eventually he'll develop a feel for the waves, right? So similarly, you can completely do this investment business at a very high level, okay? By just doing this, just look at the charts and try to develop a feel for it. Because remember, human beings are natural, they're very good at pattern recognition. All humans are pretty good at, some maybe better than others, but as human beings we have a natural ability to recognize patterns. Okay, that's one of the reasons why we have survived. Okay, so we have a natural ability to recognize patterns, so tap into that and see if you can get a feel for how the market is moving. Okay, and what I would encourage you to do is, if you feel that this is something that you'll not hear in most places, even outside the academy, is that if you should be very if you feel that you're getting a very good feel for price movements, right? You're able to estimate price movements quite well, and you're quite comfortable with how price, quite comfortable with taking bets, going short, losing money, fine, doesn't matter, go short again. Okay, whatever, you are going long, losing money again, going long. If you're quite comfortable with this, because you see, it doesn't matter, you don't have to be right all the time. Okay, you're not going to be right all the time, so that is something you should already accept. It doesn't matter, you don't have to be right all the time. You just have to make, just make money over the long term. And if you don't lose a lot of money on each trade, then you can still afford to play for, because you'll be given say $1 million. Okay, so if you don't bet a huge amount of money on each trade, then you can still play for multiple trades, right? So you should not expect to make money, you should expect to lose money. Okay, so then go in with that mindset, but still try to develop a system of trading which will help you to make money over the long term. Is that clear? But what I would say to you, what I would say to you is, I would want to give you a green light, okay, which you will not get anywhere else, which is that if you feel very comfortable with just looking at the market as like a surfer looks at waves, right? Like you're not really concerned with ITC, whether it has a cigarette division or whether it's launched a new line of biscuits, okay? All this analysis of the business strategy and the financials and all that. If you want to trade from a purely technical basis, okay, which means you just look at prices. Okay, you just look at prices as charts moving like waves moving up and down, and you just want to, because remember, you don't have to, if you make money, if you can correctly sense which way the price is going to go, you don't have to be able to explain it or understand it, right? Does everyone understand that? You just, if you develop a feel for price movements, you don't really need to know whether they have a cigarette division or whether they are launching biscuits and this, that, okay? Because you can just see some line going up and down and then you trade based on that. Now, some people may feel that even though they're good at it, they may feel that, oh my God, this is not the right way to do investments. But I would say no, don't fall into that trap. This is absolutely an okay approach. Okay, there are many people who are making very significant amounts of money over many periods, and they trade from a purely technical perspective. Okay, they don't look at fundamentals. Okay, they look at liquidity and stuff like that, which is volume, which is a technical market factor. But if you feel comfortable trading from a purely technical basis, don't worry about it. It's a perfectly legitimate approach. Okay, to trade, and you can manage serious amounts of money with a purely technical approach. So don't feel, this is the one thing that you would not hear in most places, that it's okay to have a purely technical approach. Okay, don't worry about it. If you feel comfortable, just go dive into it. Because if you can develop the skill, this is one of the most important skills that you will develop. Okay, it's a very valuable skill. Always remember the important thing is your risk management, because everything is uncertain, right? So therefore, how you manage your risk is very important. If you if you are given $1 million as a risk capital pool, right, and you risk $800,000 on your first trade, then you only got $200,000 to play with. So that should not be the approach. Okay, so typically we say that we should not risk, this is just a thumb rule, you can use a slightly larger number, but typically we say you should not lose more than 1% of your risk capital on each trade. Okay, so therefore if you do that, then how many trades do you have to lose? How many losing trades do you need in a row to lose all your capital? 100, right? So that you can say is a very low probability. Actually, there's a more sophisticated way to estimate this, but since we are not going into that right now, the important point I'm emphasizing is take a very low number, a very low percentage of your risk capital, which should be put at risk on any individual trade, because any individual trade is basically just a pie in the sky guess. Okay, you're just taking a chance. All right. So be comfortable with this approach. But the most important thing is risk management. Okay, so start looking at the market. Start thinking in terms of these of having to make bets. Okay, having to make bets. Making a bet means I'm making a commitment, either going long or going short. Okay, making a bet and then also having a risk, having a stop for your trade, right? So the technical name when we look at order types will be a stop order. We don't actually call it a stop loss order, but in loose terms, in layman's terms, we use the word stop loss, right? So the way to manage it is by choosing the position size, how many shares you buy or sell. Okay, in India you can actually buy or sell even one share. In the US, the minimum trade size is 100 shares. Okay, but in India you can even do one share. So you adjust your shares position size and the size of the stop to make sure that your risk is controlled to a very low percentage of your risk capital. Are you guys following so far? Because I'm covering a lot of material which we are not really writing down, but the video will capture it. Everyone is following?
Yes, sir.
Okay. So if you don't follow anything at any point of time, it's your duty, because I can't look at everybody's face and analyze the expression and see whether you have not understood. Okay. So therefore, please, it's your job to immediately pipe up if you haven't understood anything. Okay. Because all these things are important, and eventually, that if you don't understand this, you may have problems later on. Okay. So this is so have you understood your mandate broadly? What you have to do? Look at the Nifty 50 stocks. Take each stock. Go through this analysis, and also I've given you mainly the technical perspective so far, but you also obviously have to look at practice the fundamental analysis also. Okay, I don't know if you'll have time for all that, but ideally that is what you would do. You would also look at the fundamentals of ITC. What you can do as a shortcut is listen to your business TV, listen to CNBC TV 18 or all these other business channels that you have. Bloomberg also is there in India, right? Then ET Now and all these places. So all of these channels will be discussing most of these big name stocks. So from time to time, if you get a discussion or you look at some brokerage reports on Money Control, you might find some brokerage reports. Okay, look at some of those reports and try to see what their assessment is. Okay, those brokerage houses. And the other interesting thing you'll notice about the typical tradition in the equity analyst community, whether it's in India or abroad, you'll notice one thing, that we are talking in terms of a stop loss for every trade. You'll notice they never give you a stop loss. So if you look at a typical brokerage report for ITC, they might say that our price target for ITC is whatever, 320. Okay, so when the price is over here, they might say, typically you'll notice that equity analysts will talk in terms of a 12-month price target. Okay, so they'll say 275 is the price right now. Let's say they say that my 12-month price target is 320. This is how they'll talk. Okay, now as an investor, okay, fine, suppose on the basis of your, and they say that we have a buy rating, obviously, right? Are you familiar with this kind of talk? Some of you might be who are watching the investment programs, right? So typically you'll find if you watch it now, you should watch it now, okay? But now you have no choice. You better start following that stuff, okay? Every day, at least a couple of hours of Indian business television and a couple of hours of business of Bloomberg TV through YouTube during US markets. I don't know how much you can manage, but whatever you can manage, okay? So when you start doing that, you'll find that both in India and everywhere in the world, equity analysts, which is equity analyst is a pretty important role, okay, a core finance role. Now, equity analysts will always talk like this. They will say 12-month price target. So my 12-month price target is 320, let's say for ITC. Now, as an investor, if suppose I buy on the back of your recommendation, you say I have a buy rating and my 12-month price target is 320. Okay. Now, if I buy, now suppose I buy and the thing keeps dropping. Okay. So at what point do I? At some point I have to throw in the towel, right? I need to cut my losses at some point. But they never mention the stop loss. Okay, so now you realize how, and the problem with this kind of forecasting is, see, which means, like suppose I am the equity analyst who set 320, 12-month price target. Okay, one thing that might happen is that 12 months have already passed and it has not come to 320. So now you know I'm wrong. Okay, but otherwise, in between, before that, first 6 months or so, even if the price drops to 230 or something like that, I never gave you a stop loss, right? So the prices dropped from 275 to 230, maybe even to 200 for the first three, 4 months, let's say. So at what point did see how much money the investors lost, right? But there's no stop loss. So this is not a very intelligent approach to investing. But funnily enough, it has prevailed all over the world because nobody asks this question. Typically, if you ask your financial advisor, okay, what he will say is, no, you hold on for the long term. It will come back in the long term, okay? So this is what will happen. Typically, they'll give you a long term which is so long that by that time, that person would have also disappeared. And maybe you would have also disappeared with if your losses keep getting larger. So there's a lot of garbage. There's a lot of garbage in the investment in the investment business, okay, and there's limited accountability. So if you see but that's why I'm telling you to make sure that you always think in terms of a stop loss, because that is a much more scientific and sustainable approach to investing. Because these people, they don't really have any accountability. Okay, so for instance, so if you have a stop, now suppose I had given you, if I were an equity analyst, and now if I've given you, let's say, a buy rating at 275, and I've given you, let's say, a target of 320. Why 320? I can even give you a target of 350, let's say. But I've also given you a stop of, say, 248, this low over here. Okay, I'm saying that if my view is right, then it should not go below this. So this 250, let's say, okay, 250. So I've given you, now you see the beauty of this kind of investing. Now maximum I'll lose on this is $25 rupees per share. Okay, so I can size my position accordingly to see that, okay, I don't lose more than whatever amount of money I want to lose per trade. This is a much more scientific and structured approach to investing, which will help you to survive. Because typically, if you go with that typical equity analyst approach, where there's no stop loss, okay, and that's not a very scientific approach to the business. But unfortunately, it prevails all over the world, even in the US, everywhere, all over the world. But you should always approach it from this, using the additional concept of the stop loss. That way, you keep yourself accountable to yourself. You don't fool yourself. Okay, you keep yourself accountable to yourself, and it's a sustainable approach to investing. Okay, is everyone following so far? Okay, yeah.
So sir, I bought 25 shares of PNB.
Okay.
And the price was 82 when I bought. That was a month ago. So right now the price is going 70 and it's continuously going down. Today only it came up.
Okay, let's see if we have PNB. Okay.
So sir,
Achha, you couldn't find any other bank to buy.
Sir,
you bought PNB.
Sir, our company suggested this bank.
Who suggested?
Sir, internship, SMC local.
Okay, SMC, I don't know. Okay, but so.
Sir, earlier we also bought LNT shares. Thank you.
So this is the first lesson is, don't buy based on anybody's investment advice, okay? Don't buy it based on anybody's investment. Do your own analysis. It can't be that bad, okay? It's not that complicated, okay? It's not that complicated. You are as a human being, and always look at charts. I'm not pushing you to be a purely technical analyst. But even if you are going to use fundamentals, the charts are objective, okay? So you have to look at charts even if you're a fundamental analyst, because it tells you where the stock has been and where, at least it tells you historic. See, there, as I was telling you, there's a lot of uncertainty about the future, okay? But the charts are not showing you the future, they're showing you the past. So it's a historical record of where it has been, and historically. So you should be able to see this. At least any human being will have some kind of idea, okay, better than an investment advisor, to have some kind of idea of what to do, and no matter what you do, you have to use stops, because you recognize that the future is uncertain, okay? So the future is uncertain, so therefore everything that you're doing is a bet, okay? Everything is a bet. So don't think that, in many textbooks you'll find this distinction being made between investment and gambling. That's a totally stupid distinction, okay? There is no such investment which is not gambling. Everything is gambling, okay? If I order something on Amazon today which will reach me after 3 days, I'm actually taking a gamble that I'll be alive after 3 days. That is also a gamble, because how do you know what will happen? Okay, everything you do in life is a gamble. So this notion that there's this concept of investment, okay, and there's something else called gambling, that's all total rubbish. Okay, don't buy this all kinds of garbage that you find in finance textbooks. So everything is a gamble. Everything in life. Maruti is setting up a plant in Sanand. That's also a gamble. That's no less a gamble than if Shivam goes to Macau and puts his money on a casino, some bet somewhere. Both are gambles. So don't think that one is gambling and one is investment, because everything is uncertain. Okay, so understand that everything in the future is uncertain. Okay, so everything is based on projections, either projections on number of cars that will be sold in India, which Maruti is using to calculate the NPV on its new project in Sanand. Okay, that's also based on number of cars they will sell, average selling price per car. Okay, all these assumptions go in. Everything is a bunch of assumptions. Okay, and everything is a gamble. So if you recognize that, then you should. So therefore, when Shivam goes to Macau, if he's going with $10,000 to play with, he should not bet whole 10,000 on one trade, on one first gamble. He should parcel it out, maybe $500 a piece, and keep trying till he, strikes it rich, right? So that's a much better approach. So therefore, the concept of stop loss is very critical. That it recognizes the fact that everything is uncertain. Therefore, whatever you're doing is just a bet. It's just a gamble. So if it doesn't work out, you better exit at a reasonable price. Okay, at a reasonable loss. Okay, so this is the idea. Now let's come back to her problem. Now PNB, what happened? You bought at what price?
82.
Okay, so now it's stopping. So what you have to have now, the other problem is, you see here another problem, that most of the time when people invest, they don't have a plan. You see what I'm telling you to do before you make the investment decision to get in or out, to go long or short. Before that itself, you should have a point on the chart. You should have identified a point on the chart at which you will get out. Because that means at that point you say that, okay, at this point I have to accept that I'm wrong. Okay, so the first thing that she should have done is, now let's look a little bit closer and zoom into this. Obviously this thing doesn't look good. I mean, of course I could be wrong, but it doesn't look good. Okay, whether you look at fundamentals, and why would because see, fundamentally you have to understand, most of these Indian public sector banks, they're all bankrupt 1,000 times over. Every budget the government plows thousands of rupees into them because their share capital is all wiped out. Okay, so they've been bankrupted. I mean, this is the greatest damage that Indira Gandhi did to our country, that nationalization of banks. I mean, it's just because every generation is paying for this. Okay, since 1969-70, every generation is paying. The number of times we recapitalize these banks is shocking. In every budget they plow more money into it. They are bankrupt like 1,000 times over. We should have just let them go. Hopefully in the second term Modi will do it. I'm not sure whether he can pull it off, but thankfully they have learned their lesson from the failed Air India privatization. So this time they're going for 100% private sale. Okay, so let's get rid of Air India, and then my biggest dream is, now let's privatize all these nationalized banks, including SBI. Just privatize everything. Because all these losses would not have happened, all this fraud would not have happened if there had been private businesses. Okay, because the Lala will count even 1 paisa. Okay, when his own money is on the line, he will count even 1 paisa. But here this has happened, this fraud has been possible because it's nobody's money. It's the government's money, so it's nobody's money, right? So let's come back to her problem now that she has a problem. So if we look at it slightly, so we are now trying to zoom into this part. Okay, there's a small rally, and then, okay, I hope you guys are not bored by this problem. Okay, so this is where it's coming from. Let's say this is the daily, which is dropping from 240, right? Yeah, so it's dropping from this 240 level. That's what we are looking at. So the simplest thing you can do, you bought it at 82 or something. Yes. Okay, 82, right? So the simplest thing, as far as the stop loss is concerned, it's very simple. You can just stop it here. You just zoom in here, and you just identify this low. See, there is a rally happening from here. Okay, rally, everyone understands? Yes. When it's going up, we say it's a rally. Okay, so there is a little bit of a rally happening here. Okay, so one of the things you could do is just make sure you cover your the loss side first. That's most important. So this should be your stop. at the max. Okay, so 60 or you can even make it tighter if you want, which is you see a smaller rally from here, so you can even make it this low if you want to, or so 73.80. You can read out the actual levels by going to this chart. Okay, or you could make it here 68.80. In a situation like this, I mean, I would not place a stop wider than 68.80 because overall the chart pattern to me doesn't look bullish. Okay, it looks bearish. So the worst case should be 68.95, this low, whatever it actually is. And then if you really want to be really conservative, you can actually look at this as maybe a 1 hour chart here. $68.75 or something I said, and this is the other one. See, now also if you really get zoom in, this is the higher level of zoom, but if I take a even further zoom here, then you can see there's another small rally happening from here. Can you see that? Can everyone follow? Okay, so I could if I really wanted to be conservative, then I could even use this low here, whatever it is. Looks like 73.50 or 73.75 or something like that. Yeah, same problem. Okay, good. Okay, so same problem. You guys are, I mean, what you've done is essentially, it looks like a bearish situation to me overall.
But
so when you bought, yeah,
I bought it at 86.
86. So essentially you have to take a view, and if see, first is you secure your downside. The first thing, so the first investment mistake that these people have made, which is, I don't blame them because this is the kind of garbage that investment advisors put out. Okay, that this notion of you should never invest in anything without knowing your exit point. Okay, so you should always have first principle of investing is, which is not typically taught in the finance textbooks or even in the financial planning courses that you might do. Okay, so that's why you should recognize this is all garbage, because it doesn't recognize the fact that everything is a gamble. Okay, so the first thing you should have done is, what they should have done is, before entering, they should have identified the point at which they will exit. Okay, and what they should have additionally done is, they should have, let's say they were going to invest only one share per trade, one share per trade. They were only going to trade in one share. Okay, then if she was entering at 86, okay, she should have already looked at that chart. She must have entered when did you enter?
86.
No, when? Which date? June.
Yeah.
Okay, June means here. Okay, so June is starting from here. See how June looks like, it didn't even go to 86. So that guy must have added some margin for himself and sold you when the highest price was 83. He sold it to you at 86. So anyway, it doesn't seem to have gone. Okay, whatever. My point is, let's say they are buying in June. Okay, let's say the price is around 83.30 or something when they are buying. Let's assume. So they should have already identified a point like this, which is, okay, if it goes below 68.70, then I'm going to get out. Okay, and if they have a certain amount of money that they should have already identified a certain amount of money, like before you invest, your basic rule is you should have identified, let's say take a 1 year period, you should have identified the amount of money you're willing to lose in that 1 year period. Okay, so let's say it's 10 lakh rupees. If you're willing to lose 10 lakh rupees, then you should not bet more than, say, roughly I'm saying 1% of 10 lakh per trade. Okay, so then you take that figure, which is your 1% of your risk capital. You can't lose more than 1% of that on per trade, and you assume, for the sake of simplicity, that every trade you're entering at market. So if they're entering at 83, what they should have done is look at the difference in 83, identify the point at which you have to exit in the case of a loss, see the difference between this point and 83, okay, and take one share per trade, or the number of shares you want. The number of shares you want to do is basically, the number of shares is such that, given the difference between the entry point and the exit point, times the number of shares, you should not lose more than your maximum budgeted loss. Are you following my logic? Okay, let's say, where are we on time? We are almost, this goes till 3. Okay, let me just quickly do this exercise. That's a quick, important exercise. We are doing it here today itself, okay? Calc, let's just keep it as calc, okay? Alright, so let's say, let's make it simpler. My total investment capital, total risk capital for the year is 100,000, okay? So I want to take this times This 1%, how did I arrive at 1%? That there are more sophisticated way to calculate this percentage. We're not going into that now. I just want to choose a very low number so that I can have many shots at gold, right? Okay. So I'm losing not more than 1,000 per trade. Okay. So now entry price for Sakshi is 83, let's say. Okay. Now exit price. Okay. Let's label these things. Annual risk capital, ARC. Okay. Risk per trade. Is everyone following so far? You understand what is annual risk capital? It's the amount of money you can afford to lose in a given period. Could be 1 year, 1 quarter, one day also. And that amount of money should be such that you don't really care. If you lose that money, fine, it's not a big deal. Okay, you can still have your lifestyle. You can still continue with everything else you're doing. Okay, that should be how you set your annual risk capital. Per trade, you are risking not more than 1,000 because you are using the 1% rule. Okay, you want to keep a low percentage. Okay, then entry price is 83. And what did we say the exit price is? Let's say it's 68 half, let's say. Okay. So exit price, there are two types of exit prices. We are now looking at the more important of those two, the exit price on loss, because there's also an exit price on profit. Okay, that also will bring in another dimension into the trading calculations. Okay, exit price on loss is 68, 68.5.
Yes.
Right. Okay. So now therefore projected loss per share is 83 minus 68 half, okay, 14.5. So therefore the number of shares, most people actually decide the number of shares arbitrarily. The number of shares is actually a endogenously determined variable. You understand endogenous, exogenous? When we do models, we'll cover that, okay? But number of shares is not to be arbitrarily determined. It is derived. It's a derived number. Okay, how do you decide the number of shares? First you decide assuming your entry at all entries are at market, to keep it simple. Okay, all entries are at market. Set the exit price by looking at the chart. You saw how I did it. It's a reasonable approach. Okay, previous low. Then having looked at the entry price and the projected exit price, and you know how much you can't afford to lose more than 1,000. Okay, so therefore you have to basically take number of 14.5 per share you're losing. So you can only do. Is everyone following this? Oh, sorry, I'm increasing the number. So let's look at the decimals. But then obviously essentially it means you have to buy 68 only. Is everyone following this logic? That is, if you do the calculation once again, if you lose 14.5 per share, okay, and you have invested in 68 shares, okay, so we are going to do 68.97, okay. If you have invested 68.97 shares, your total loss will be 1,000. Is this clear? So Mehak, are you clear now how you arrive at that number? So this is the actual way of approaching the problem. This is a systematic way of approaching the problem. You have to decide your exit point before you enter. Most of the time what happens, you would have seen from not just your friends but all your relatives who have invested in the stock market, they don't plan the exit because they only see good times. Okay, they don't see the exit on loss. So then there are other aspects to this, which is exit on profit. There are many things like reward to risk ratio, which those things we will look at. We have actually pretty much covered many of the decision problems in investing, but this session was important because it gives you a structure as to how you will approach your investment problem that you have in the project. Did you feel that you learned anything?
Yes, sir.
Okay, fine. Because we spent most of the time on stuff which I had not planned to teach. So, because we were trying to cover the course material. But this is important because you need to get ready for your project. Okay? In your project, you'll be doing it with live data. Okay? Everything is live in the project. Everything is real except for the money. The money is paper money. Okay? But you should take it seriously. So, alright. So, is everyone clear now?
Yes, sir.
You got your answers? Okay? Exit the position. Okay. And also, if what happens is another thing, one sec, guys. Do we have any time? Okay. Okay, fine. So let's all hope and pray that PNB goes to 240 or something like that.
At the time of election and after the result came up, the price was actually almost 100. Yeah.
Almost 100.
Almost 100. So that's the suggested that, and SNC has a policy that if, like in India, you said now, if we buy one.
Okay, you guys can leave. You guys can leave.
In India has said that you can buy one share also. But to cover this thing, SNC has a policy that we need to give 25 rupees brokerage. As a holding cost of you need to pay 25 rupees brokerage, otherwise if you total brokerage comes below 25, then your minimum brokerage of 25 will be charged.
Minimum brokerage of 25.
Every company has a different policy. SNC has this policy of charging.
I think the first rule is never invest on the basis of what people say. Form your own view. It's not that complicated. And especially if you take a purely technical approach, it's much less complicated. And it's a completely legitimate approach. Yeah. So, and you should only stick to liquid stocks. Don't go outside the Nifty 50. In real life also when you invest, don't go outside the Nifty 50. Not worth it. Because here you have liquidity. If you invest in purely liquid, very, very liquid instruments, a purely technical approach is 100% legitimate. It's much simpler, makes your life much simpler. It's an easier way to start in the investment business. Then you can also study the fundamentals on the side. Okay, clear? Okay. Which one? Earnings call. Okay, we'll do it in the next class.